Alright, so Nvidia just reported another monster quarter. And honestly, this is one of those earnings reports where the numbers almost look fake at first glance. We are talking about a company that did $81.6 billion in quarterly revenue. Not annual revenue, quarterly revenue. That was up 85% year over year and up 20% just from the previous quarter. So before we get into valuation, upside, downside, risks, all of that, just pause on that for a second. Nvidia added about $13.5 billion of revenue sequentially in one quarter. There are entire large public companies that do not generate that much revenue in a year. So yeah, fundamentally, this was a very strong quarter. But here's the deal. The stock reaction was muted, even slightly negative after hours. And I actually understand why the market might react that way. Not because the quarter was bad. It clearly was not. Nvidia beat revenue expectations, guided above consensus, generated absurd free cash flow, and kept margins near 75%. The issue is that Nvidia is no longer being judged like a normal company. At around $223.47 per share, with a market cap of about $5.45 trillion, investors are basically asking how much perfection is already priced in. And that's really the whole Nvidia debate right now. Before we go deeper, make sure to like the video, subscribe to the channel, and drop a comment with your take. Is Nvidia still a long-term compounder from here? Or is the stock finally getting too expensive? Now let's walk through the quarter. The entire story is still data center. Nvidia did $81.6 billion in total revenue, and data center alone was $75.2 billion of that. That means about 92% of the company's revenue came from data center. That is incredible. But it also tells you where the risk is. Nvidia is not really being valued as a gaming chip company anymore. It is being valued as the core infrastructure supplier for the AI build-out. The company is selling GPUs, networking, systems, software, and increasingly the full stack needed to build what management calls AI factories. And data center revenue grew 92% year over year. Sequentially, it grew 21%. That is not normal megacap growth. That is infrastructure cycle growth. The more interesting detail, though, is not just compute. Data center compute revenue was $60.4 billion, up 77% year over year. Still huge. But data center networking revenue was $14.8 billion, up 199% year over year. That part matters a lot, because if Nvidia were only selling individual chips, the story would be powerful, but maybe easier to attack. What the networking growth suggests is that Nvidia is becoming more than just the best GPU supplier. It is becoming the integrated AI infrastructure platform. Large-scale AI is not just about buying a chip and plugging it in. These systems need high-performance networking, interconnects, software, optimized systems, and a full architecture that actually works at scale. That is where Nvidia's moat starts to look much deeper. This is where it gets interesting. The company is also reorganizing its reporting around two platforms, data center and edge computing. Inside data center, it will break out hyperscale and ACIE, which includes AI clouds, industrial, and enterprise. That should be useful going forward because investors need to know whether Nvidia is still mostly riding hyperscaler spending or whether AI demand is broadening into enterprises, industrial use cases, and sovereign AI. Right now, hyperscalers are clearly carrying a huge part of the story. Over time, the bigger question is whether the second wave of demand can show up strongly enough to keep growth durable. Now look at profitability. Nvidia's GAAP gross margin was 74.9%. Non-GAAP gross margin was 75%. For a company doing more than $80 billion of quarterly revenue, that is ridiculous. Margins improved massively year over year, although there is some context. Last year's quarter included a $4.5 billion H20-related charge, so the comparison is helped by that. But sequentially, margins were basically stable, moving from 75% to 74.9%. So the real takeaway is this: Nvidia is scaling at an enormous pace, and margins are not collapsing. That tells us pricing power is still strong. It also suggests customers are not yet in a position where they can easily force Nvidia's economics down. Operating leverage was also huge. GAAP operating expenses grew 52% year over year, which is a big increase. But revenue grew 85%, and GAAP operating income grew 147%. So Nvidia is spending heavily, especially to maintain product leadership and build out its ecosystem, but the revenue base is growing even faster. That is exactly what you want to see from a dominant platform during a major cycle. And then there is free cash flow. Free cash flow was $48.6 billion in one quarter. This is not a small number. In fact, this might be the single most important number in the entire report, because it shows the AI boom is not just showing up as accounting earnings, it is turning into real cash. Operating cash flow was $50.3 billion. Free cash flow was up 86% year over year. Nvidia is basically printing cash while still investing in the business. The balance sheet is also extremely strong. The company had $13.2 billion of cash, plus $37.1 billion of marketable debt securities, $30.2 billion of marketable equity securities, and $43.4 billion of non-marketable securities. Debt was only about $8.5 billion. So balance sheet risk is not the issue here. This is not a company with weak liquidity or dangerous leverage. The risks are different. They are valuation, competition, geopolitics, customer concentration, and whether AI spending stays this strong. Nvidia also returned about $20 billion to shareholders during the quarter, authorized another $80 billion of buybacks, and increased its quarterly dividend from 1 cent to 25 cents per share. The dividend increase is symbolically nice, but let's be real. The buyback is the more important part. At this market cap, even $80 billion is not going to radically shrink the share count overnight, but it does show how much cash the business is producing. Nvidia has more cash coming in than it can immediately reinvest organically. Now let's talk guidance, because this is where the quarter gets even more impressive. Nvidia guided Q2 revenue to $91 billion, plus or minus 2%. That was above expectations of around $87.3 billion to $87.4 billion. And this guidance assumes no data center compute revenue from China. That is a big deal. It means the guide is strong even without China data center compute contribution, but it also highlights one of the biggest risks. China remains excluded, approvals remain uncertain, and geopolitical restrictions are still a real overhang. So if you are bullish, you might say, wow, Nvidia can guide to $91 billion even without that China contribution. Fair point. But if you're cautious, you might say, okay, but this also shows how exposed the business is to policy decisions outside its control. Also fair. I would not ignore this. Management's message is very clear. They believe AI factories are becoming the next major computing infrastructure layer, and Nvidia wants to be the platform underneath that entire build-out. Jensen Huang described the AI factory build-out as accelerating at extraordinary speed. The company also highlighted Blackwell adoption, Vera Rubin being on track for the second half of the year, agentic AI, reinforcement learning, CPUs, edge AI, robotics, automotive, sovereign AI, and AI RAN. That is a lot. And normally, when a company has that many growth stories, I get a little skeptical. But in Nvidia's case, the current financials are strong enough that the broader vision is not just hype. The revenue margins and free cash flow are already backing up a lot of it. Still, the next platform transition matters. Blackwell demand is strong today, but Vera Rubin is the next major milestone. When a stock is valued this richly, the market needs confidence that the product roadmap can keep extending the cycle. Now let's move to valuation, because this is where the story becomes less clean. At $223.47 per share, Nvidia's market cap is about $5.45 trillion. Using annualized Q1 numbers, Nvidia is trading at roughly 30 times annualized non-GAAP EPS and about 28 times annualized free cash flow. Price to annualized sales is around 16.7 times. That is expensive, but it is not irrational in the way some unprofitable hype stocks are irrational. Nvidia is not a company asking investors to believe profits might show up later. The profits are already here. The cash flow is already here. The question is whether they keep growing from an already massive base. Annualized Q1 free cash flow is about $194 billion. That is insane. But for the stock to work from here, the business probably needs to push free cash flow meaningfully higher over the next 5 years, while defending margins and avoiding a major multiple reset. And that is where I land on the stock. Great company, demanding valuation. The base case in the analysis assumes Nvidia can reach about $500 billion of revenue in 5 years, with net margin around 50%. That gives net income of around $250 billion. With the share count falling modestly to about 23.5 billion shares, EPS would be around $10.60. Apply a 28 times earnings multiple, And you get a 5-year share price of about $297. From $223.47 today, that is about 33% upside, or roughly 6% annualized before dividends. That is positive, but it is not screamingly cheap, and that is really important. In the base case, Nvidia remains a dominant company. Revenue grows, margins stay strong, buybacks help, the business keeps winning. And yet, because the starting valuation is already so high, the expected return is good, but not amazing. Now the bull case is still exciting. In the bull case, AI infrastructure becomes a multi-year global build-out that is comparable to cloud computing, but faster and more compute-intensive. Inference demand explodes. Agentic AI becomes widely adopted. Enterprise AI moves from experimentation to production. Sovereign AI spending increases, and Nvidia maintains dominance across GPUs, networking, software, CPUs, and systems. In that scenario, revenue reaches about $650 billion in 5 years. Net margin stays around 52%, EPS reaches about $14.70. Put a 32 times multiple on that, and the stock could reach about $470. That would be roughly 110% upside from today. So yes, Nvidia can still double from here in the bull case, but that outcome requires a lot to go right. It requires sustained AI spending, durable margins, limited disruption from custom silicon, and continued product execution. The bear case is not that Nvidia falls apart. That is not the right way to think about it. The bear case is simply that AI capex slows after the current build-out, hyperscalers move more workloads to custom silicon, China remains restricted, pricing pressure increases, and margins normalize faster than expected. In that scenario, Nvidia could still reach $375 billion of revenue in 5 years. Net income could still be $150 billion. This would still be a wildly profitable company. But if EPS is around $6.25 and the market assigns a 22 times multiple, the stock would be around $138. That would be about 38% downside. So the risk is not business failure. The risk is expectations, and that is the part I would pay attention to. Nvidia's biggest risks are pretty clear. First, AI capex digestion. At some point, customers may slow spending to see what return they are getting from all this infrastructure. Second, customer concentration. Nvidia's biggest customers are some of the most powerful companies in the world. Over time, they have every incentive to negotiate harder, diversify suppliers, and build custom silicon where it makes sense. Third, margin normalization. A 75% gross margin is amazing, but I would not assume it stays there forever. If margins move toward the high 60s or low 70s, Nvidia can still be excellent, but earnings power changes. Fourth, geopolitics. China being excluded from guidance is manageable right now, but it remains a major uncertainty. And finally, valuation. Even a great company can be a mediocre stock if expectations get too high. So where do I personally land? I would call Nvidia neutral to moderately bullish. Operationally, the thesis is improving. The company is executing at an unbelievable level. Revenue growth is massive, margins are elite, free cash flow is extraordinary, and the platform strategy looks stronger than ever. But the stock is not a clear bargain at this price. At $5.45 trillion of market cap, Nvidia needs sustained earnings growth to drive returns. Multiple expansion alone is probably not something I would want to rely on. So for long-term investors, I think Nvidia remains one of the highest quality businesses in the market. But I would frame it as a great company at a demanding valuation, not an obvious no-brainer. If you already own it, this quarter probably strengthens the long-term business case. If you're looking to buy today, I think valuation discipline matters a lot more than it did a few years ago. Because from here, the stock can still work, but it has to earn it. And that is the Nvidia story right now. Incredible business, incredible execution, incredible cash flow, but also incredibly high expectations. If you enjoyed this breakdown, hit the like button, subscribe for more stock analysis, and let me know in the comments where you stand. Is Nvidia still worth buying at this valuation, or is the market already pricing in too much perfection?